want to give you a view of the world from a supply-side perspective, which is unique. It's, it advocates free market capitalism, pro-growth capitalism, and there are what they call the four grand kingdoms of macroeconomics in the supply-siders world are monetary policy, fiscal policy, trade policy, and then what they call incomes policies, which are everything else. And in fact, when I was getting ready to come up here, I was talking to my wife, and I said, honey, in your wildest dreams, would you ever imagine me speaking to the imported ACG chapter of New York? She looked at me funny and said, honey, you're never in my wildest dreams. Rich people can afford more accountants and lawyers and congressmen and senators than the rest of us. And they do. And rising costs are something they don't like. It'd be the same as if you were to burn somebody with a match, they recoil. It's human nature. They're not going to pay higher tax rates. They won't get the revenues they need from those increases in tax rates at the highest levels. They just won't. Never have gotten. Remember, as a percentage of GDP, the rich pay about 19% through all kinds of tax rates. I don't know how they do it. They find a way. So I've traveled my Wall Street career. I was an institutional equity salesman, very involved in equity research. I've run capital markets for a boutique. I had the good fortune of working directly with a man named Arthur Laffer, PhD, developed the Laffer curve. He was a confidant of Ronald Reagan's, first chairman of the OMB at 29 years old, and a legendary figure, a supply-side economist, and I basically ran research output. I was the only person there. There was a stock picker. Everybody there was PhD and analyst level. And my goal was to try to connect the dots between, as I put it, something happens at 30,000 feet at the macroeconomic level, and something jumps and runs on the forest floor. Fiscal policy. Tax and spend. Fiscal policy. Tax rates have a significant incentive effect on behavior. They really do. You tax the rich all you want, they're not going to pay. As a percentage of GDP, the rich, the category of the rich, have paid about 19% of GDP at tax rates as high as 70% and as low as 28%. Go look at that figure. It's phenomenal. It turns out people do not work to pay taxes. They work for an after-tax return. And they'll work very hard not to pay taxes because it represents a rising cost. It's as simple as that. It's math. Not able to raise them recently. The budget negotiations were excruciating. People were yelling the system's broken. I would argue the system's not broken, it's working. Think about it. The House of Representatives flips every 2 years, right? I kind of see that as sort of a ripcord on bad policy. Policy was going off course as far as good economic policy. Boom, the House flips and it's over. At least we're not going to see cap and trade. We're not going to see union card check rules. And tax rates didn't go up. So I'm telling you that the battleship sort of moved. It sort of came to the center. And I'd say it's a beautiful, elegant process and system that created that change. And that's where my hope comes from to the future. Free trade agreement. And this is one powerful agreement. And so we, for instance, noticed Singapore's GDP growth last year was 14.9%. It's hard to find, as a public company investor, a company growing at 15% top line. Here's a country doing it. And by the way, folks, it doesn't happen in a vacuum. It's 100% related to the fact that CAFTA was enacted in '09, and Indonesia is a free trade nation. In fact, they really don't make anything. They trade everything. They're a poster child for free trade. So there you go. There's a consequence of a fabulously powerful free trade agreement, and there are investment consequences to that right now that any of us could run out and find some opportunities in Asia based on the huge amount of trade that's started and going to continue between those countries. That's really good policy. And by the way, they've been cutting tax rates all over Asia as well and liberalizing their markets. So we believe Asia is for real, and there's a long tail to this success story until those policies change. Bear markets are a lot more common than bull markets. If you go back and look at the last 100 years in the United States, and you analyze the legendary bull and bear markets, and you analyze how long they lasted, it's kind of upsetting. You know, the Roaring '20s was a 4-year bull market, and yet we still talk about it. Followed, by the way, by over a 14-year depression, which led into World War II, obviously. The go-go '60s, which I always heard about. It's under a 6-year bull market, under 6 years, followed by a 16-and-a-half-year bear market. From the late '60s, the entire '70s, and part of the '80s. whereby if you had $1,000 invested in the USS equity markets in 1966, $1,000 invested, it was worth $275 by the beginning of 1982, inflation adjusted. But that's a bear market, folks. That's bad news. And then, of course, it was followed by what I'll call the Reagan-Clinton bull market, which was a solid 20-year run when you look at it. And again, I don't think these things happen in a vacuum. Booms and busts do not happen in a vacuum. They're most often tipped off by government economic policy or changes in government economic policy. I mean, you know, if anybody studied economics, you know, David Ricardo's gains from trade. A great deal of specialization happens after a free trade agreement like that. If you're not isolated in Indonesia, you know, then if you're isolated, you're trying to produce everything that you would consume. When you enact a regional free trade agreement or a big free trade agreement, you now don't have to manufacture those things you're not good at manufacturing, right? You can now open up, sell the things you're really good at making to other people, and then buy those things from them that they're better at making. It's kind of like, you know, people always fear China and the U.S. I mean, I think China's the greatest trading partner in the world. We really need cheap goods, and they got them. You know, and then that goes back to oil. You know, we need to be self-sufficient in regard to our oil policy. Well, yeah, there's no doubt about it, but on the other hand, you know, we know how to use oil. The Middle East produces a great deal of it. Why not trade? About that, I guess. But I will say this, the U.S. is not Greece, and I wrote an article about this recently. I'm getting more excited about the fact that we are fundamentally not Greece. Doesn't that sound wimpy? But I'll tell you what I'm thinking, and maybe you'll be on board, and you probably look, maybe you'll be cynical about it, but I think it's a nuance that's worth considering. If you look at Greece's situation, Portugal's situation, they did not address their debt problems to the extent that they have, by the way, which is limited, until outside forces came crashing in and made them. Bond prices blew open, credit default swaps blew open, and the ECB came bearing down on them. Oh, and they've got to address it. But the U.S. has already started addressing them without any outside influence. China's still buying our treasuries at very low yields. No outside influence is wagging its finger at us saying, get your fiscal house in order. The government is the giver and taker of incentives, and people still respond to incentives. If you were to raise the price of this fabulous shirt by 100% tomorrow, I'd be wearing that ugly shirt the next day. I'm just kidding. But the point is, you know, people adjust to incentives, and the government is the biggest giver of incentives. And so what I'm going to try to do is kind of go over where this government or governments are deviating from good economic policy in each of those four categories of the grand kingdoms, if you will, to give you a perspective of what we think is causing so much dislocation. And Martin Ochner helped me come up with the title, Finding Corporate Growth Strategies in Government Policy. I think the title might be more like not growth strategies, but defensive strategies. You know, how to defend against government policies. I had a CEO tell me the other day, I talked to a lot of companies, public and private, and he said, you know, from a regulatory perspective, American business has an enemy on its own shores, and it's our government. And I really believe that to be the case. If it's OSHA, or if it's the Federal Labor Relations Board, if it's the EPA, if it's Dodd-Frank, it dramatically affects capital formation in this country.